All right, we're diving deep today, folks, into the world of private equity. We've got a whole stack of articles and research here, and we're going to try to figure out if this is something you should be considering for your retirement portfolio.
Yeah, it's really interesting. Private equity used to be this super exclusive thing,
Mhm.
only for the ultra wealthy. But now it's becoming more and more accessible to everyday investors. And with retirement planning on everybody's minds these days, it's no wonder everybody's talking about it.
Okay, so maybe it's not as like hush-hush as we thought, but before we get too far ahead of ourselves, let's break it down. What actually is private equity?
Right, because the name itself can be a little bit intimidating. Basically, private equity is all about investing in companies that are not publicly traded on the stock market. So this could mean buying out a public company and making it private, or
Right.
investing in a private company that's trying to grow.
So essentially, you're buying a piece of a company
Yeah,
with the goal of making it more valuable over time.
exactly. And that's where the potential for those higher returns comes in. Historically, private equity has actually done better than the stock market.
Higher returns. Okay, man, you've got my attention. But why is that? What makes private equity so potentially lucrative?
Well, one reason is this active ownership approach. So private equity firms, they don't just passively invest. They really get involved in the businesses that they buy. They might bring in experienced managers, streamline operations, and, implement all kinds of growth strategies. So it's about actively working to improve the business.
So it's not just picking the right companies, it's rolling up your sleeves and actually making them better.
Right. Another thing is that long-term focus. Private equity investments are usually locked in for several years, and this lets those firms make strategic decisions without the pressure of, quarterly earnings reports
With the
and
volatility of the stock market.
that makes sense. You can sort of ride out those short-term ups and downs and focus on building value over a longer period. Exactly. And because private equity isn't directly tied to the stock market, it can offer a level of diversification that can be really valuable when it comes to retirement planning.
Diversification, it's like that old saying, don't put all your eggs in one basket.
Exactly. By adding private equity to your portfolio, you're spreading your risk across different asset classes. And this can help cushion your portfolio during market downturns, which are inevitable.
Okay, I'm starting to see why people are getting excited about this. But let's get real for a second. We've talked about the potential upside. What are some of the downsides, the things that we need to watch out for?
Well, one of the biggest downsides with private equity is illiquidity. Because your money is locked in for several years, you can't easily get to it if you need cash quickly. That's why it's generally considered a long-term investment. And it's also why financial advisors are usually pretty cautious about recommending it to people who are nearing retirement.
So if you're thinking about early retirement or you might need to tap into your savings in the near future, private equity might not be the best fit.
Exactly. And, while private equity can offer those diversification benefits, it's important to remember it's still subject to market risks. Economic downturns can definitely impact private companies too, which can affect the value of your investment.
Right, so it's not a magic bullet. And I'm guessing there are fees involved, just like with any investment?
Yeah, and fees can be a pretty significant factor with private equity. These funds, they typically charge management fees and something called carried interest, which is a percentage of the profits. And these fees can eat into your returns, so it's really important to understand the fee structure before you invest.
So it's not just how much you could potentially make, but how much you actually get to keep.
Exactly. And then there's this issue of transparency. Historically, private equity firms have been less transparent than publicly traded companies, so it can be trickier to get detailed information about their operations, their strategy, and their performance.
So you're really putting a lot of trust in those fund managers. You need to do your due diligence and make sure you're comfortable with who's managing your money.
Absolutely. But the good news is the industry is becoming more transparent, partly because of increasing regulations.
Okay, that's good to hear. So we've got this kind of complicated picture starting to emerge here. High potential returns, diversification benefits, but also illiquidity, fees, and those transparency concerns. There's a lot to think about. What are the experts saying about all of this? Are they all in on private equity, or are they a bit more cautious?
Well, it's kind of a mixed bag. Some financial advisors are hesitant, especially for people who are close to retirement, because of that illiquidity factor we talked about.
Makes sense. You don't want to jump into something like this lightly if you need to access your money quickly.
Right. But other advisors see those potential long-term benefits. especially for younger investors who have a longer time horizon.
So it seems like your individual circumstances really matter. Your risk tolerance, your time horizon, all of that really matters when you're considering private equity.
Definitely. It's not a one-size-fits-all type of investment.
And it's not just about personal gain, is it? Private equity actually plays a bigger role in the economy as a whole.
That's a really good point. Private equity firms are often investing in companies that are developing new technologies, creating jobs, and driving innovation.
So it's not just about making money. It's about fueling growth and progress.
Exactly. Private equity can be a really powerful engine for economic development. But, let's bring it back to you, the listener. What are some key questions you should be asking yourself if you're thinking about dipping your toes into this private equity pool?
Okay, so we've talked about how private equity can help build personal wealth and how it plays a role in the bigger economy. But with this much power, there's got to be some kind of responsibility, right?
What about regulations for private equity? Is anybody keeping an eye on this industry?
Oh, absolutely. The rules and regulations around private equity have actually changed a lot in the past few years, and they're still changing.
So it's not just a free-for-all? No, not at all. There are a bunch of regulatory bodies, both in the US and around the world, that are keeping a close watch on private equity. These regulations are designed to protect investors, promote transparency, and make sure everything's fair.
So what kind of things do these regulations cover?
One of the biggest things is disclosure. Private equity firms now have to give their investors a lot more detailed information. Things like their investment strategy, their fees, their performance, even their risk management practices.
So it's all about lifting the curtain and letting investors see what's really going on.
Exactly. And this increased transparency helps investors make smarter decisions about where to put their money. There are also rules about valuation, which is super important in private equity because these assets aren't traded on a public market.
Why is valuation so crucial in private equity?
Well, it's not as simple as looking up a stock price. Figuring out how much a private company is worth is a lot more complicated. It involves different methods and takes a bunch of different factors into account. And regulations make sure that those valuations are done fairly and consistently.
So it's all about keeping things on the up and up, making sure everybody's playing by the same rules.
Right. There are also rules to try to prevent conflicts of interest. For example, a private equity firm might be tempted to favor one of their own portfolio companies over another when they're making investment decisions. But these regulations help ensure that all investors are treated equally.
It sounds like they're really trying to find a good balance between allowing innovation and protecting investors.
That's the goal. And it's an ongoing process. The rules are always adapting to the changing world of private equity and the financial markets.
So it's not a set it and forget it type of thing. The regulations are constantly evolving as the industry changes.
Exactly. And that's a good thing because it means the regulators are paying attention and trying to keep up with the latest stuff happening in private equity.
Okay, so we've got this whole regulatory framework in place, but let's zoom out for a second. How does private equity actually compare to other ways people can invest their money? For the average person trying to plan for retirement, how does private equity stack up against, say, the stock market or real estate?
That's a great question. It's really important to think about all the different options when you're building your retirement portfolio. Let's start with the stock market. Investing in public companies through stocks is what most people are familiar with.
Yeah, it's what we see on the news every day. The Dow Jones, the S&P 500, all that.
Right. And there are definitely some advantages to investing in stocks. It's very liquid, meaning you can buy and sell shares really easily, and there's a lot of information available about public companies, so you can do your research and make informed choices.
Okay, so it's accessible and transparent. But we already talked about how private equity is the opposite, illiquid and less transparent. So how do they even compare?
That's where things get interesting. While those things might seem like drawbacks for private equity, they can actually be strengths in certain situations. For instance, the fact that private equity is illiquid, well, that forces you to have a long-term outlook, which can lead to bigger returns over time.
Because you're not tempted to sell when the market dips. You have to ride it out.
Exactly. And while the lack of transparency can be a little worrying, it can also give private equity firms more flexibility. They can make strategic decisions without having to worry about the scrutiny of the public markets.
Okay, so there are pros and cons to both. What about real estate? That's another popular investment for retirement. Where does private equity fit in with that?
Well, there's actually a lot of overlap between private equity and real estate. Some private equity firms specialize in real estate investments. They might invest in anything from office buildings and shopping centers to apartment complexes and farmland.
So you could actually invest in real estate through private equity.
Yes, and a lot of people do. But it's important to understand the differences. Investing in real estate directly, like buying a rental property, gives you a lot of control. But it can be a lot of work.
Yeah, you're the landlord, you're dealing with tenants, you're responsible for maintenance. It's definitely hands-on.
Right. And then you have REITs, real estate investment trusts, which let you invest in a bunch of different properties without having to own them directly.
But then you don't have as much control, do you? You're basically buying shares in a company that owns and manages those properties.
Exactly. Private equity real estate funds offer a different approach. You're giving your money to experienced fund managers who are experts in finding and managing real estate investments. They handle all the research, the negotiations, the financing, everything.
You're basically taking advantage of their expertise and connections.
Right. And you're also getting diversification. These funds usually invest in a bunch of different properties in different locations and different sectors.
Spreading the risk, just like with stocks.
Exactly. So when you're comparing private equity real estate to other real estate options, it really comes down to what you prefer and how much risk you're willing to take. Do you want to be involved in the day-to-day, or do you want something more hands-off? How much control do you want to have over your investments? These are all really important things to think about.
Okay, so we've looked at how private equity compares to stocks and real estate, and it seems like each option has its own unique pros and cons. But let's be real for a second. Private equity can seem like a bit of a mystery. It's not as easy to grasp as buying a stock or a rental property. So if someone's listening to this thinking, okay, private equity sounds interesting, but how do I actually figure out if these investments are good or not? Where do I even start? What advice would you give them?
That's such an important question. Doing your research is absolutely crucial with private equity. You're basically trusting these fund managers with your money. So you have to make sure you're comfortable with who they are and what they're doing.
It's like interviewing someone for a job, but the job is managing your money.
I like that analogy. And just like in a job interview, you need to ask the right questions.
So what kind of questions should we be asking these private equity funds?
Well, you want to dig into their track record, look at their past returns, how have they handled different market conditions. You also want to get a sense of their investment philosophy. What kinds of industries or companies do they usually go for? How do they approach creating value? And of course, you need to be crystal clear on their fees. How much are they charging to manage your money? Are there any hidden costs?
Right, so it's not just about the potential gains. It's about understanding what you might have to pay for those gains.
Exactly. And don't be afraid to ask about their risk management strategies. How do they identify and reduce risks? How well have they protected investor capital during those down markets?
It's like saying, okay, what happens when things go south? Because let's face it, sometimes they do.
Exactly. And a really key question, especially in private equity, is about their exit strategy. How do they plan to sell their investments and give those profits back to investors? What's their usual holding period? What kind of returns are they expecting?
So you're not just looking at the starting point, you're also looking at how you're going to get out. And hopefully make some money along the way.
Right. And remember, you're not just evaluating the fund itself. You're evaluating the people running it. Look at their experience. Have they successfully managed similar funds in the past? What kind of reputation do they have in the industry?
It really comes down to trust, doesn't it? You're giving these people your hard-earned money. You want to be confident that they have the skills and the integrity to manage it responsibly.
Absolutely. And here's one more piece of advice. Don't be afraid to walk away if something doesn't feel right. There are a ton of private equity funds out there. You don't have to settle for one that doesn't meet your standards or match your goals.
So it's about being picky, doing your homework, and making sure you're confident in the decisions you make. Now I'm thinking about the bigger picture. Where's all of this headed? What does the future of private equity look like? What trends are shaping this industry? And what should investors keep in mind as they try to figure all of this out?
Well, one of the most important trends is the role of technology. We're seeing AI and machine learning being used to analyze huge amounts of data, find investment opportunities, and even manage portfolios. It's really changing the game.
So it's not just about intuition and spreadsheets anymore.
Not entirely. Data-driven decisions are becoming more and more important in private equity, just like in a lot of other industries. Algorithms can process information and spot patterns that we might miss, and that can lead to better investment choices and higher returns.
It's like having a superpowered analyst working with you, right? Crunching those numbers and finding those hidden trends.
In a way, yeah. But it's important to remember that AI is only as good as the data it's using. And there's always the risk of bias. Human judgment is still super important.
So it's not about replacing humans altogether. It's about giving them better tools to make smarter decisions.
Exactly. Using technology to make better choices, but not blindly following what it says.
Okay, technology is a big factor. What other trends are you seeing that are shaping private equity?
Another one is specialization. Instead of investing in all sorts of different companies, we're seeing more funds that focus on specific areas, like healthcare, technology, or renewable energy.
So investors can really zero in on investments that match their interests, or maybe their knowledge of certain industries.
Exactly. And this lets fund managers develop a deeper understanding of those specific areas, which often leads to better investment decisions.
It's like the difference between a general doctor and a specialist. You might see a general doctor for a checkup, but if you have a specific health issue, you want to see a specialist who really knows their stuff.
That's a great comparison. And this move towards specialization is also tied to the rise of impact investing, which we talked about a bit earlier. Investors want their investments to align with their values. And specialized funds let them put their money into things like renewable energy or sustainable agriculture, where they can see a real impact.
So it's not just about making money, it's about making a difference.
Exactly. And private equity is a good fit for impact investing because it takes a long-term view and because it can really push for positive changes in the companies it invests in.
It's like using money to make a better world.
That's the whole idea behind impact investing, and I think it's a trend that's only going to get stronger.
So we've got technology, specialization, impact investing, all really big forces shaping the world of private equity. What are the experts saying about where all of this is headed?
Most experts are predicting that private equity will keep growing. Big institutions like pension funds and endowments are putting more and more money into private equity. And individual investors are getting in on the action too.
So private equity is becoming mainstream.
It's definitely becoming more accessible. And people are understanding it better. And as the industry keeps growing and changing, it's likely to attract even more investors, which will lead to even more innovation and competition.
And competition is usually good for everyone, right?
Mm-hmm.
It can lead to lower prices and better products and services. What does that mean for people who are investing in private equity?
Well, it could mean more opportunities to invest, lower fees, and more transparency. All good things for anyone who's interested in exploring the space.
We've covered a lot of ground today. We talked about what private equity is, explored the rules and regulations, compared it to other investments like stocks and real estate, talked about how important it is to do your research, and now we've looked at the trends that are shaping the future of the industry.
It's been quite a journey, a real deep dive, and I hope our listeners are feeling more confident about navigating this complex world.
Absolutely. So as we wrap things up, what's the one big takeaway you'd like to leave our listeners with today?
I think the main thing to remember is that private equity isn't just for the super rich anymore. It's becoming more and more accessible. And it could be a really good way to grow your money, especially if you're thinking long-term and you're willing to do your homework.
But it's not without risks. It's important to understand those risks, do your research, ask the tough questions, and make sure private equity is a good fit for your goals and your risk tolerance.
Perfectly said. It's all about being informed and making choices that are right for you.
Exactly. And as the world of private equity keeps changing, who knows what new opportunities and challenges will come up. Maybe we'll dive back into this topic again sometime and see how things have evolved.
I'd love to.
Until then, thanks for listening, everyone, and happy investing.